Thursday, August 21st. Welcome to MarketFoolery. I'm Chris Hill. Joining me in studio today from $1 Million Portfolio, Mr. Ron Gross. Good to have you here.
Good to be here. I didn't know we'd be on video, or I would have shaved.
I did, and in fairness,
Maybe put on a nicer shirt.
I didn't tell you that these get videotaped now and thrown up on YouTube. So, for the tens of people watching on YouTube, Ron cleans up nicer than he looks right now.
Thank you.
But
Appreciate that.
you are one of those people I was thinking of when last Thursday I was in here with Bill Barker and I said, hey, we're pre-taping episodes to run this whole week, and we got some special guests. Some people who don't normally show up on the MarketFoolery, and you are one of them.
I'm happy to be here.
One programming note, which is that we're not going to be here at all next week. We're taking the whole last week of August off. It is our gift to you. Take a little break. I hope everyone listening gets a little bit of a break, or has maybe already gotten one this summer.
The whole company isn't taking a break. You made it sound like the Motley Fool will not be here.
I won't be here.
Right. Okay.
And MarketFoolery won't be here, but we'll be back on Tuesday, September 2nd. But as longtime listeners of the Motley Fool Money radio show know, you run $1 Million Portfolio. You also run our MDP Deep Value service. You're a value guy at heart. And I'm curious about deep value investing. But let's talk just how do you view value investing? Because I get the sense that even within the world of value investing, there are people who look at it a little differently. How do you look at it?
I think that's fair. I think there's some overriding concepts that most value investors probably can get on board with. And I think the most fundamental of those are that value investing is based on the concept that you're looking to buy a company, buy a stock, at a price where it is cheaper than what you think that company is actually worth. You're looking for a bargain.
Than what you think it is worth today.
What you think it is worth today, and that can also mean a lot of things. We could almost teach a whole MBA class on what that means, because that's typically a present value concept.
Well, let's save that for another time.
We'll save that for another time. We don't want to bore people. But what we think it is worth today, and we're trying to buy it for less than that, which makes perfect sense. You wouldn't want to buy something for more than you think it's worth. In a very real sense, you could say all investing is value investing because you're not looking to overpay for something. But value investors are really focused on that value, often called intrinsic value in the value investing world, and estimating what we think something is worth. And there's many ways to do that, and then comparing it to a stock price.
Does that mean you miss out on stocks? Because obviously, we all miss out on stocks, but I'm curious, how often do you run into a situation where you're waiting for a stock to get to a particular price, or do you not wait for that?
Well,
I know you wait for at least a range.
You're absolutely right that it causes us to miss out on stocks. And I will say in deep value investing, where we're looking for really cheap stocks, it causes us to miss out on lots and lots of opportunities. But value investors are okay with that. I think that the most famous example of that is Warren Buffett, whose stock last week went over $200,000, the A stock for the first time. He's famous for staying away from technology. He says it's because he doesn't understand it. I think he's being a little bit humble there. I think it's really that he can't value those companies well because their futures are too uncertain for him. And therefore, he's missed a ton of amazing companies that went to quadruple, 5, 6, 10 times go up in value. And I think he sleeps just fine at night in the knowledge that he's let those go, because what is the alternative for him? It's investing in something that he doesn't know or doesn't understand and can't predict, and for him that would be a mistake.
So what pushes something into the category of not being a value stock but a deep value stock?
So at deep value, we're looking for, as I said, real cheap. So not just a company that is selling for less than we think is worth, but something that is selling for significantly less.
Do you put a number on it?
Typically, we look for something that is perhaps 30 or 40% undervalued. The concept of margin of safety is pervasive throughout value investing, and that kind of that phrase it's the difference between what you think it's worth and what the stock is selling for right now. It's that difference, and that difference represents a big part of what your upside would be. because you're buying something at a discount, but it also represents your protection, because that's why it's called margin of safety. Because if you get it wrong, if your valuation analysis is just dead wrong, you're building in a buffer. So where you will not lose money, you will not have a permanent loss of capital, which is what the definition of risk for most value investors. So deep value, we're looking for really cheap, and that means stocks, specifically to our deep value service here at the Motley Fool, stocks that have no future growth baked into their cash flow, even though a company may be growing, but for some reason the rest of the world doesn't believe it. Companies that are perhaps trading at a discount to their net asset value. We focus on balance sheets quite a bit, not just the income statement or the cash flow statement. And they've got to have strong balance sheets, companies we can understand, and companies we can predict with fairly good certainty.
These seem like they would be somewhat at odds with one another, because if a company has a really strong balance sheet and presumably they have some management that you have a level of trust in, then what is the stock doing down 40% from where it should be?
That's a good question, actually.
Thanks.
Way to go. So I think first you have to it's dependent on the waters that you're fishing in, and it's easiest to find deep value opportunities when you look at small or even micro cap stocks. These are companies that are just not widely followed by the broader market, certainly not followed by the typical Wall Street research analysts. They're just too small. Mutual funds, institutional investors, for the most part, stay away from them because you can't accumulate enough stock to make it worth your while, and as a result, inefficiencies crop up in that side of the market. Now, you would think over the years, with all the microcap and small cap and value mutual funds, that those inefficiencies would somehow have closed. You would think that would happen, but in my experience, it actually has not. It's perhaps closed a little, but the opportunities are still there. So we're looking for companies that nobody else really cares about, but also the other piece of the puzzle is that something lately is not going right. So a company can have a great balance sheet and could have grown at least somewhat nicely in the past, but right now there's a hiccup, there's a problem. That's where the analysis comes in, where you have to see, do you believe that that's a temporary problem, or if it will it persist into the future? And that's where you can get the difference between a value and a value trap. Because if you buy something at a discount that is going to just deteriorate, that's certainly something we want to stay away from.
So let's get specific with some companies here. What are a couple of companies right now that you look at and you say, yeah, that's a deep value opportunity, and it may not work out well, but it meets the criteria as we've laid them out?
Sure, and may not work out well is interesting, because I find if you do it right and you don't lighten up on your criteria, the vast majority, 80% or more, will work out. I can't speak to what your actual rate of return will be, but you will have a profitable outcome. But you have to stay true to the value investing criteria. So in this market that is at all-time highs,
right,
it's not really very easy to find good deep value opportunities. In the deep value portfolio, I would love to have 10 right now if I could, and we only have 7, and I'm desperately looking for 1, 2, or 3 more, but it's not easy to find. We like a company, Titan International is a good example, ticker symbol TWI, a maker of industrial tires, really large tires for agricultural, mining companies, industrial uses. That's a company selling, it's a $750 million market cap, stock's around 14, I think it's worth $25. And what's going on now is it's a cyclical industry. Right now there's too big a surplus of tires in the mining and agricultural industries, so sales and cash flow are depressed. But that won't persist forever. Eventually, this company will start selling tires again. Cash flow will rebound, and the stock should at least follow suit. Another example would be a company called Lidl Industries, which is LDL. We won't get into too much about what they do, but they make thermal, acoustic, and filtration devices for both automotive applications as well as medical applications. The company's just underfollowed. No one's ever heard of it. I defy you to find a person that's heard of this $470 million market cap company. But yet they do a great job. They just made a company transforming acquisition. Cash flow is strong. Balance sheet is strong. One day, someone will wake up and realize that this is an opportunity. And actually, that's an important thing we should mention, is that patience is an absolute requirement for value investing. Some value investors focus on catalysts. Will only invest in companies where a near-term catalyst is easily discernible. We think value is its own catalyst as long as you're patient. But the good thing is that eventually people see the value and activist investors come in. These companies get acquired. The value is eventually realized for those that are patient.
I want to get to activist investors for a second, but you've touched on something a couple of times that I think is worth highlighting a little more, and that is this idea of lack of coverage and what that means for individual investors like you and me and anybody listening, because it really is one of the maybe easiest to overlook stories of, I would say, the last 5 years on Wall Street, is how methodically the number of analysts at Wall Street firms, that talent pool has diminished as Wall Street firms have cut jobs, and therefore how coverage has diminished. And so the number of, not just the number of analysts covering stocks has gone down, but the number of stocks getting coverage has gone down. And so now there are literally thousands of stocks that maybe have one Wall Street analyst covering, but a lot of them, there's no one covering them. And I have to believe that even against the backdrop of a rising market like we've had the last 18, 24 months, that does present an opportunity for investors.
It should. Dissemination of information in general causes markets to be more efficient than not. The internet, of course, has created just a flood of information and has theoretically made it more readily available to investors, which makes the market more efficient as well. However, there's enough out there, and there's enough companies, as you say, that aren't being looked at, aren't followed. We can't, when we look at analysts that cover stocks, we can't forget about all the mutual fund and hedge fund analysts that are out there that are doing their own work. It's just not visible because they're not these sell-side, in quotes, analysts.
Right. They're not putting out
research reports.
Yep.
But there's still a ton of capital that are looking at these individual companies, even if there aren't those research reports being published.
Tim Hansen has made the point a couple of times that there are a few things he loves hearing more when he's calling a company than when someone at the company says, wow, you're the first analyst to ever call us.
Love that.
Great.
Love that.
Love to hear that. I'm going to close with a question that I asked James Early the other day, and that is stepping back from value investing. You're someone who looks at the market every day, every week. We're past the halfway point of 2014. What are some of the things that you're looking for over the last few months of this year, whether it's we've got some big things coming, right? We've got the end of the bond buying program. We've got individual companies that are coming out with their various announcements. There are certainly things on the horizon, but I'm curious what you're watching, whether it's a company or an industry.
I'm tending to focus because I'm not finding a lot of value opportunities. So I'm looking for companies, especially in $1 million portfolio, that have some nice growth going forward. And that causes me to keep an eye on the economy, just perhaps a little bit more than I would, especially in this environment where stocks are not really that cheap. So we saw some good growth, some GDP growth. I'm hoping that continues. Rising interest rates have to be in our future. There's just no way around that. I'm always wondering what that means for both my valuation models, but what it's going to mean for the market as a whole. And so I'm tending to look not for deep value. There I'm going to stay in cash and be patient. But on the other side, a $1 million portfolio, I'm looking for companies that have nice growth, nice sustainability, nice competitive advantage, and can continue to grab market share from other companies.
I forgot. I said we were going to get back to activists. I do want to get back to that.
Please.
Because you used to be an activist investor back in your hedge fund days. Yep. In deep value investing, is that something you're rooting for? Is that something you're obviously? I'm assuming once you have bought a stock that you think is a deep value stock, if one of the catalysts that you've baked into your scenario is an activist coming in, then yeah, you are hoping for that.
So it's never. I'm not a catalyst type of value investor. As I said, I think value is its own catalyst. Eventually, value will be realized. But as long as I'm finished accumulating my position, I'm typically happy to see an activist investor comes in because that will hopefully end up in increasing shareholder value. It depends on who the activist is. It depends what their motives are. I prefer the activists that want to get on the board, want to help a company grow for the long term, not ones that are these quick hit guys that come in and then dump their stock after they've made a quick 10, 15, 20%. But in general, overall, usually an activist coming in is good for our stocks.
Ron Gross, thanks for being here.
Thank you.
As always, people on the program may have interest in the stocks they talk about, and the Motley Fool may have formal recommendations for or against. So don't buy or sell stocks based solely on what you hear. That's going to do it for this edition of Market Foolery. Show is mixed by Dan Boyd. I'm Chris Hill. Thanks for listening. Enjoy the last week of August. We will see you on Tuesday, September 2nd.